A seven-figure income short-term rental cost seg study. My client invested in a short-term rental in Florida. They split their home between their Montana home and their Bay Area home. Just a little point of reference. The cost seg is showing a $350,000 immediate depreciation expense. They have a bookkeeper keeping track of their books. Both the spouse and the taxpayer kept track of their hours for material participation. Since they did not place the rental in service until December, they feel that they will meet the material participation test. Now, are you comfortable, or am I comfortable, or whoever's comfortable, putting this information on the tax return? And the reason I bring this up is because last year, personally, I represented 5 seven-figure taxpayers with this scenario. And none of them won. One's in appeals. One is in appeals. I don't think they're going to win in appeals, but they're in appeals. We got a better shot with that one. This is a $10.5 million property down the road here in Lake Tahoe. And the deduction there was $850,000. So it was worth taking to appeals. Now, let's talk about, Mark, material participation. Because this is really what this boils down to. Otherwise, wait, I should preface this. Is this a passive activity?
That's a great question. That's one of the first places to start. You say it's a rental. And by the way, just grammar. Do you have 7 figures worth of income in the short-term rental?
No, seven-figure income.
Your client is a seven-figure income.
Yeah, my client has a seven-figure income.
I want to make sure I got that right.
Obviously they've got a $350,000 plus loss here. They're looking to offset their seven-figure income.
So the first thing you're looking at is, so a rental is per se passive, but there's exceptions to the passive rules, one of which being short-term, an average annual stay of 7 days or less. And that's what we're talking about here, our short-term rental, our Airbnb type place. And so as long as we're not in that, now we're suddenly not in the same rules. If we're not a passive activity, we still need material participation in order to be able to start counting these losses. So now we go into material participation. That was the last time they renamed the tax code, 1986. If you haven't had the education, I don't think there's ever a time where I don't read something about these regs from the 1980s and still learn something new. They were voluminous. They're incredibly well detailed. They had an incredible number of employees at the IRS writing these things. So it's always good to go back and make sure you understand those passive rules, whether or not you're going to hit material participation, significant participation activities, the 100-hour rule, and nobody does anything more, and knowing who anybody else is. So I think that's a real key for us here. If we're going to make these decisions, and obviously the numbers are significant. You're talking about someone who's in the top tax bracket. These deductions are coming in with significant numbers. You should be able to make that distinction and reasonably back it up with some type of reasonable research in your work papers about that material participation activity.
Now, Tom, have you heard of this going on out there? Is there something on TikTok that I don't do TikTok. I'm just curious.
It actually has a fancy name. It's called the short-term rental loophole. Anybody heard that phrase before, right? But you're right, the IRS is auditing them, and the key is good records. I do know one colleague who had an audit on this issue, and he won it. Although there was another issue that was uncovered that was bad. One material participation found that was placed in service in the wrong year. Oops. But again, the documentation is going to be key. You know, when people kind of promote the short-term rental loophole, they kind of leave out the dirty details of the documentation that you need. Because let's be real, you claim a $500,000 non-passive loss, expect it to get looked at.
Laura, would you put the disclosure form on it?
Okay, so I'm going to challenge Mark and say, how long ago did you work for the IRS? Because I have filed probably, I don't know, 1,000 8275s in the last 10 years. I've never had an audit.
What are you doing?
I love the form. No, we have a lot of, we get client, well, we bought a practice from somebody. Maybe I should say I have bought more than one practice from people who perhaps should have not been preparing returns and in fixing things. I do a lot of
They
8275.
call her the fixer, folks.
Yeah,
You,
I'm
you
a
do
fixer.
sketchy clients. I
No.
like you. That's fun.
The client may have come to me sketchy, but they're not going to stay sketchy. Also, I'm in a rural area, and my office, I have 2 locations. One of them's in a rural area. And I swear, the people in that rural area do not know how to follow the rules. Everything, like, just an example, COVID, when you're not supposed to be at restaurants, and when you were, it was supposed to be all this, like, tables apart. People were in restaurants, in bars, cozying up to each other, no mask. There were actually doors on businesses that said, if you have a mask on, you better take it off or you cannot come in here.
This is in
This
California?
is my rural, my Calaveras County, rural
Gosh, I was
county
living in the wrong space back then.
in California. Anyway, so I refer to a lot of the clients we get from Calaveras County as Calaveras disasters. And yeah, I do a lot of these things, and I've never been audited. The one time I actually had to produce it was the IRS sent a letter asking a question, and I said, as was stated on the originally included 8275, the response I got back was, okay, never mind. So maybe they've changed a little bit, or they're being drowned by them because of people like me.
So the key with this, and I know we're going down a rabbit hole, but I apologize.
Why not?
The key with disclosure is, why would you do it? Well, disclosure generally helps if you don't have substantial authority for a position, but you have a reasonable basis and you want penalty protection. Unless that's what you're doing, I don't see maybe why you would want to do that. Now, if you have an uncertain position, absolutely disclose. But I don't think we need, and this is just my opinion, I don't think we need to disclose everything that could be uncertain. If we have substantial authority, we don't need to disclose as long as we retain our analysis in our files.
David, you want to join in on this conversation? Not about, you don't have to join in disclosure. We go back to the original question if you want.
Well, I've done 8275s on occasion when it's really something I think just needs to be disclosed and there's no other mechanism to do it within the confines of the return. But getting back to the initial question at hand, I always want to verify that they meet that 7-day average stay. I want to see the Airbnb report. I want to see the Vrbo report. Why? People forget this, but there are long-term stays in Airbnbs. I've had clients that have had multiple month-long tenants in Airbnbs. Why? They weren't allowed to have short-term tenants in their condos, so they decided to have long-term tenants, and they did it through Airbnb. They still consider it a short-term rental. Well, in your mind it may be, but under the law it's not.
And in Florida, that is very popular. Just as a side note, my client's business in Florida here, that's a very popular scenario for snowbirds to go down and rent in these places. Another one that we have to, when you brought that up, traveling nurses will use an Airbnb a lot of times. They'll be spending a month or 2 at a time.
Can I just address one thing about the place in service in December? There's a tax court case that says the rule is average length of stay. To have an average, you need more than one. So just remember that. If you only have one stay at the end of December for 3 days, that's not an average. You don't meet the requirement.
Now, does the rules change? Let's just use 3 stays, 5 days each, 15 days. I also stayed there myself for 10 days.
What did you do? Were you there doing cleaning, maintenance, repairs, remodeling, and do you have the receipts from the local Home Depot, Lowe's, whatever, to that location that tie to those days? And was it reasonable that it was going to take 10 days to do that stuff? You cannot buy paint, that's day one. Mask off stuff, that's day two. Then do a primer coat, that's day three. What I'm getting at is you cannot take something that should have taken a half a day and extend it over 10 days so that you can write your vacation off as being not personal use. My point is, if you were using the property, you happened to be staying there while you were working on it, and that's how you got your material participation, those days don't count. But if you were there soaking up the rays or enjoying the slopes or whatever was appropriate, and those were not part of your days, uh-oh.
Can you, so you brought it up, so you open the door, can I ask a question? I'm there working on the property. I'm masking, I'm painting, I'm doing all that work. My wife's down there with the grandchildren going to the beach.
That's okay. Just one of you has to be there for the repair, maintenance, work, improvement, whatever. So you can do the slave labor. The rest of your family can tag along and do whatever they want.
Pretty cool.